Finance operates on a continuum of complexity that most people never see. At one end, you have the basics: budgeting, saving, and investing in common assets like stocks and bonds. But at the other extreme lies a highly sophisticated world of advanced markets, instruments, and strategies where trillions, and sometimes hundreds of trillions, of dollars in notional value change hands every year. Today, we're exploring that deeper end of the pool. From the immense global derivatives market, valued by some estimates at over $700 trillion in notional exposure, to cutting-edge treasury management tactics, intangible asset valuation, and the often overlooked role of chief financial officers who orchestrate large-scale capital flows. By the end of this video, you'll see how the real big money moves and how advanced finance techniques can either fortify corporations for decades or bring them to their knees in spectacular fashion. First, let's put the derivatives market in context. While the term 700 trillion might sound hyperbolic, these figures come from notional values of various derivatives contracts worldwide. Think interest rate swaps, currency futures, credit default swaps, commodity options, equity index futures, and more. Although notional value doesn't directly translate to the same level of risk, the existence of so many overlapping exposures speaks to the scale and complexity of modern finance. When a multinational corporation decides to hedge currency risk on its $10 billion in annual foreign sales, or a pension fund tries to secure future liabilities worth $100 billion through swaps, these transactions feed into the broader ecosystem of derivatives. The result, a massive, constantly shifting web of contracts that influences everything from mortgage rates to corporate earnings reports and even government debt costs. Yet, derivatives are only one part of this advanced financial universe. At a fundamental level, the question is always, how can capital be allocated, managed, and protected in a way that maximizes value and mitigates risk? This question becomes critical for large organizations that generate billions of dollars in annual revenue. But it's also relevant for smaller businesses trying to stay competitive. Finance at the highest level is about orchestrating everything: where to invest cash, how much debt to carry, which projects to greenlight, how to hedge exposures, and how to present a coherent story to investors who are trusting you with their capital. Enter the role of the CFO. Traditionally, many people picture the chief financial officer as the head accountant, the person who oversees budgeting, audits, and historical financial statements. Today's CFO, however, is far more strategic, a linchpin for major decisions on capital allocation, risk management, mergers and acquisitions, investor relations, and even intangible asset creation. They're also deeply involved in shaping the narrative that goes out to shareholders, analysts, and credit rating agencies. When a Fortune 500 CFO discusses shifting $5 billion into share buybacks versus investing it into new R&D labs, they're effectively deciding between immediate returns to shareholders and the pursuit of long-term growth. That decision can hinge on interest rates, economic forecasts, the company's leverage ratio, and intangible factors like brand strength or the competitive landscape in emerging technologies. On the topic of intangible assets, consider that intangible value often dwarfs physical asset value for many of today's largest tech and consumer brands. Companies with market capitalizations of $500 billion or more might own relatively modest physical assets, like server farms or office leases, but are flush with intangible assets, such as patents, intellectual property, proprietary algorithms, brand recognition, or massive user communities. Valuing these intangible components requires a departure from classic textbook formulas. You can't just run a simple discounted cash flow on a patent library without considering synergy, network effects, or the broader ecosystem in which those patents are deployed. The intangible economy is also reflected in the wave of special purpose acquisition companies, SPACs, tech IPOs, and private equity investments targeting software-based firms. Investors are banking on intangible value that can scale up exponentially rather than linear, asset-heavy business models. Shifting gears, let's drill down into treasury management, an often underappreciated but crucial piece of advanced corporate finance. Treasury management deals with a firm's short-term and medium-term liquidity, cash flow, and marketable securities. Picture a global firm with subsidiaries in 20 different countries, each dealing in local currencies and local regulations. The CFO's Treasury Department must ensure that each subsidiary has enough funds to operate while also optimizing the entire corporation's overall cash position. This can involve complex cash pooling arrangements, netting systems to offset receivables and payables among subsidiaries, and the use of currency swaps to reduce exposure to exchange rate fluctuations. In an era where a single percentage point can translate into tens of millions of dollars in saved interest or improved yields, treasury management plays a profound role in a company's competitiveness. Another advanced tactic is supply chain financing, sometimes referred to as reverse factoring. For companies with global supplier networks, supply chain financing can shift payment timelines, reduce uncertainty, and even improve the working capital metrics of both the corporation and its suppliers. A big retailer, for instance, might partner with a financial institution to pay its suppliers early at a slight discount, while the supplier gets earlier access to cash and the retailer technically extends its own payment deadline. This can show up in corporate filings as improved free cash flow or better days payable outstanding, DPO. At scale, especially with billions of dollars in annual procurement, such financial engineering can significantly boost short-term liquidity and even alter how equity analysts value the firm. Now, let's circle back to risk management. Beyond just hedging with derivatives, true risk management in advanced finance includes rigorous scenario planning, stress testing, and evaluating strategic pivots. Think about a pharmaceutical company with $2 billion in annual R&D betting on successful FDA approvals. If a high-stakes clinical trial fails, the firm not only loses years of investment, but also faces a stock price crash. A robust risk management framework would have earmarked alternative uses for R&D resources, diversified the pipeline, or secured licensing deals that offset some of the clinical trial costs. In a world where a single regulatory decision can swing a company's market cap by billions, advanced risk management is as much about operational strategy as it is about finance. Moving up the complexity ladder again, we encounter structured finance, a domain often associated with mortgage-backed securities, MBS, collateralized debt obligations, CDOs, and other slicing and dicing of financial assets into tradable tranches. While these instruments got a bad rap during the 2008 financial crisis, they remain integral in channeling capital from investors to borrowers, including residential homeowners, commercial developers, and private enterprises. The basic idea is to bundle assets, like thousands of mortgages or corporate loans, into a pool, then sell pieces of that pool to different investors with different risk appetites. Senior tranches might have lower yield, but also a lower risk of default, while junior tranches might yield more, but bear the first losses if loans go sour. When used responsibly, structured finance can improve liquidity and distribute risk. Yet the meltdown of 2008 showed that if the underlying assets are over-leveraged or misrepresented, the entire structure can implode, wiping out hundreds of billions of dollars in value. One fascinating area of structured finance is securitizing intangible assets. Companies can, in theory, bundle intellectual property rights, like music catalogs or patents, into asset-backed securities that pay interest and principal from the royalties generated. We've seen music legends securitize their future royalties, netting immediate lump sums in exchange for the steady stream of payments. This approach might help an artist or an IP owner diversify risk and secure capital up front, while investors gain exposure to a cash flow producing intangible asset. Although it's still relatively niche, it exemplifies how advanced finance can innovate around assets once deemed unfinanceable. No discussion of advanced finance would be complete without exploring how global macroeconomic forces shape corporate decisions. When central banks like the Federal Reserve, the European Central Bank, or the Bank of Japan tweak policy rates or engage in quantitative easing, they alter the cost of capital for everyone. This has cascading effects. If interest rates drop, corporations might increase leverage or accelerate expansions, fueling more M&A or share buybacks. When interest rates rise, servicing large amounts of debt becomes more expensive, pushing companies to strengthen their balance sheets or slow down investments. On a global scale, currency exchange rates shift, influencing a firm's competitiveness in export markets. So, a CFO might pivot an entire manufacturing base to a country where the currency is relatively undervalued, potentially saving hundreds of millions in labor and production costs annually. Meanwhile, we also have to factor in regulations and compliance, which become more intricate for cross-border operations. Multinational companies must navigate multiple tax regimes, potentially leveraging tax havens, transfer pricing strategies, or tax treaties. The lines between legality and aggressive tax optimization can be blurry, and the reputational risk associated with being perceived as dodging taxes can harm a brand. From a purely financial standpoint, though, some CFOs find ways to minimize a global effective tax rate to, say, 15% or less, saving billions over time, which directly affects free cash flow and shareholder returns. In the M&A sphere, advanced financial modeling goes beyond synergy valuations. Think about how a $10 billion horizontal merger might shift market share, or how vertical integration can secure supply chains. You'll have entire teams focusing on regulatory approval, analyzing whether the combined entity might run afoul of antitrust rules or stifle competition in a certain sector. Post-merger integration is often the unsung hero or villain in these deals. A brilliant financial model can quickly sour if cultural clashes, redundant processes, and uncoordinated systems hamper the newly combined company's efficiency. On the flip side, a well-planned integration can extract the full synergy potential, cutting overlapping costs, streamlining manufacturing, or cross-selling products to new customer segments, leading to a jump in the merged entity's stock price. One especially high-level approach to M&A is the roll-up strategy, where private equity or even public companies systematically acquire smaller businesses in a fragmented industry. Each acquisition might be relatively modest, tens or hundreds of millions of dollars, but collectively, the roll-up can create a new giant with billions in revenue. The synergy arises from consolidating back-office operations, expanding distribution networks, and leveraging a single brand or sales force. Once the new entity reaches a certain critical mass, it can either be sold to a strategic acquirer at a premium or taken public. This strategy demands robust financial analysis to ensure each acquisition is accretive to earnings and that the collective synergy outweighs the integration challenges. On the innovation front, some advanced finance strategies delve into sustainability-linked financing and green bonds. With ESG factors poised to represent over $50 trillion in assets under management within the next few years, companies are seeking ways to align financial objectives with environmental and social outcomes. A green bond, for instance, raises capital specifically for projects that have a positive environmental impact, like renewable energy installations or energy-efficient retrofits. Large corporations might issue these bonds to tap into growing investor demand for sustainable investments, often enjoying slightly lower interest rates or more favorable terms. However, compliance requires transparency and third-party audits to ensure the proceeds truly fund green initiatives. This intersection of advanced finance and sustainability is a growing frontier, reflecting the market's recognition that climate risks and social considerations are fundamentally tied to economic performance. Yet another domain of advanced finance is high-frequency trading, HFT, and quantitative hedge funds. While not directly relevant to most corporate CFOs, it reshapes the liquidity and price discovery in capital markets the corporations rely on. In this sphere, algorithms execute thousands of trades per second, exploiting minute price discrepancies across exchanges. HFT influences how markets respond to earnings releases, Fed announcements, and global news, sometimes driving wild short-term volatility. Hedge funds with quant strategies might parse alternative data, like satellite imagery of parking lots or scraping social media sentiment, to predict consumer behavior before official reports are out. This environment challenges corporate finance officers to timeshare offerings or bond issuances in ways that minimize market turbulence, or to adopt robust investor relations strategies that communicate effectively in a hype-driven market. Linked to this, advanced investor relations, IR strategies, take into account the reality that many institutional investors now rely on complex algorithms and big data analytics. If you're a CFO preparing an earnings call, you're not only speaking to human analysts, but also to algorithms scanning your every word choice. Sentiment analysis can trigger buy or sell signals if the language veers too negative. IR teams might carefully craft their statements, highlight certain metrics, or guide on future earnings in ways that help shape a more stable reaction. A misstep here, or an offhand remark that implies risk, can wipe out billions in market cap within hours. We'd be remiss not to talk about how central the cost of capital is in advanced finance. The weighted average cost of capital, WACC, ties together the cost of equity, which depends on investor expectations and market risk, and the cost of debt, which depends on interest rates, credit ratings, and leverage. A company that can reduce its WACC by half a percentage point might save tens of millions annually on a multi-billion-dollar capital structure. This is why credit ratings matter. An upgrade from BBB+ to A can lower the interest rate on future bond issuances, unleashing extra cash that can be reinvested for growth or returned to shareholders. For private businesses, especially in leveraged buyouts, a lower WACC can make borderline deals feasible or transform a moderate IRR into a stellar one. Finally, advanced finance also intersects with corporate culture and ethical considerations. If a CFO focuses too heavily on short-term gains, like temporarily boosting earnings per share via share buybacks, long-term innovation may suffer. On the other hand, if a company invests heavily in intangible research without clear oversight, it risks burning through cash without meaningful returns. Balancing these tensions requires a strategic vision that aligns finance with the company's mission, stakeholder expectations, and a coherent growth roadmap. In a world where brand reputation can be destroyed overnight on social media, corporate finance executives must weigh not just spreadsheet outcomes, but also public perception, employee engagement, and broader social impact. As you can see, advanced finance is about orchestrating a grand puzzle, matching capital sources with optimal uses, hedging against known and unknown risks, leveraging intangible assets and brand equity, and ensuring that all these decisions reinforce the long-term viability of the organization. It's as much about foresight and strategic thinking as it is about number crunching. The truly exceptional CFOs, private equity partners, hedge fund managers, and corporate strategists don't just rely on formulas, they integrate a deep understanding of markets, technology, psychology, and governance. So why does any of this matter if you're not on the board of a multi-billion-dollar company? Because the same principles trickle down. A mid-sized enterprise or even a personal investment portfolio can borrow ideas from advanced finance, scenario planning, cautious leverage, diversified income streams, intangible asset cultivation like brand or intellectual property, and prudent risk management. If you're an entrepreneur, for instance, understanding how large corporates handle capital can guide how you structure funding rounds, mitigate currency risks if you have international customers, or position your company for acquisition. If you're an individual investor, knowing how derivatives, structured products, or intangible asset valuations work can help you discern market trends and avoid overhyped opportunities. In the years ahead, we can expect advanced finance techniques to become even more data-driven. Artificial intelligence, machine learning, and big data analytics will likely transform how CFOs forecast demand, manage supply chains, set hedging policies, and evaluate potential acquisitions. Meanwhile, ongoing shifts in global trade, regulatory scrutiny, and social expectations around sustainability will further complicate the financial decision-making process. Yet, if there's one constant, it's that capital must be deployed wisely to achieve sustainable growth, whether you're managing 1 million or 100 billion. In closing, the $700 trillion derivatives market is just a symbol of the sheer scale at which money moves around the world. But behind that dizzying figure lies a tapestry of strategies, instruments, and decisions that define modern finance. From the subtle art of balancing intangible assets against real-world liabilities to the lightning-fast world of algorithmic trading, advanced finance is a discipline of complexity, innovation, and relentless competition. Those who master it shape industries, influence economies, and often generate extraordinary wealth. The question is, will you harness these insights to elevate your own financial game, or watch from the sidelines as the global capital machine churns on? Thank you for joining us in this deep dive into next-level finance strategies. If you found value in this exploration, whether it's understanding how CFOs think, how derivatives hedge risk, or how intangible assets rewrite valuation models, make sure to subscribe and stay tuned. We've got more to cover in the ever-evolving world of finance, from new forms of digital currency to advanced synergy modeling in M&A. The future belongs to those who keep learning, adapting, and applying these principles to real-world situations. Now, go out there and put these ideas to work, whether in your own company, your investment portfolio, or your next big entrepreneurial venture. Because in finance, knowledge isn't just power, it's profit, resilience, and the key to long-term success.